Morning, everyone. Thank you for coming. We have a quite short but very focused panel here today. And can I start off in welcoming Robin Rossmann, which is the Managing Director of STR Global. Robin, will you please join us? Thanks for coming. Robin is joined from Deloitte, where he was a Senior Director of the International Travel, Hospitality, Leisure and Advisory Group. Robin brings with him over 13 years of experience advising leading hotel brands, operators, investors and lenders across Europe and the Middle East. Robert, highly educated and credible advisor, and we're very happy to have him with us. Thank you. The next one is Russell Katz. Russell is in with the bricks of the IHIF. Russell, would you please join us? Pleasure. Thank you. Morning, Russell.
Good morning.
I think Russell needs hardly no introduction. Russell is the chairman of the London office of HVS. He's a leading global advisor in hotel valuation, consultancy, asset management, and brokerage, which was founded in the 1980s. Russell has almost 40 years, almost since you were born, Russell, experience before you were born, in the hotel industry, and as well, it's fantastic to have you with us here this morning. And last is Andreas Kuven. Andreas, good morning. Morning, Andreas. Nice to have you. Andreas is the International Managing Director and Managing Director of Consultancy in Christian Co. Andreas is responsible on 16 offices across all services line and industries, as well as the consultancy team on Asia desk based in London. Andreas has got an extensive knowledge in merger and acquisitions, experience across the UK, Europe, the Middle East and Africa, and have done over his career over £30 billion of transaction. Nice to have you all here, gentlemen. Okay, let's start like this. I tell you, first of all, it is absolutely a pleasure to ask questions without paying for it. So this is very good. We have heard here Robert's presentation, and we can really see that figures, stats, everything, whatever you look at it, is all over the place. So really, how do you provide advice? How do you provide analysis at such periods? Can we start with you, Robin, please?
Sure. So we collect hotel performance data from about 7 million hotel rooms around the world pretty much every day. And, our business is to give the market and give investors and operators better information to make better decisions. So it's not up to us to advise on what to do, but we give the information to help people make decisions.
Mm-hmm. Okay. Russell, we take you as a balanced view in the middle.
Well, you've really got to strike a balance between what the numbers are saying and how you interpret it. And I think it's great for those who are able to collate data and put data together. But the real trick is being able to say, well, what does that mean? What does that mean historically? And what's the implication for the future? And I think all that we try and do as analysts is to say, this is what the data say, but actually this is really what it means.
Okay, Andreas?
Well, I think I'd start out by saying usually there's not one right answer, so you can interpret data in different ways, and I think it comes down to also what level of risk you want to assume. So, I think if you're looking at a valuation exercise versus some due diligence exercise, and there's always different ways of looking at the same data and interpreting that. But as Russell said, it's our job as advisors to come up with some reasonable assumptions based on the data that we're seeing, using our on-the-ground knowledge. I think that's one of the key things, having local insight into the markets and so on. But if it were easy and we all had a crystal ball, nobody would pay us any fees. So I think there's always that degree of uncertainty and so on, and it's an exciting time in the market because there's so much happening, and keeping up with it and keeping track of it all is not easy, but we try our best.
I actually disagree with all three of you. If you would have a crystal ball, I would have paid you a lot of fees. I think my father once used to say that he will pay $1 million for the FTs of tomorrow. And I really did not get a specific answer, because in the end of the day, what you're telling me is that the analysts, the advisors, is telling me more what have happened and more I would like to hear, rather than really what is the decision which should be taken according to the information which was collected. So how this is really being translated to a good advice, especially in turbulent or a little bit uncertain markets. As we've seen now, Robert himself said that the polls, whatever you decide, is 50-50. How do we focus this decision? Russell, can I turn it?
I think you're being unfair. Don't you think he's being unfair?
I am unfair,
I think the answer is, if you consistently get it wrong, then you're not in business tomorrow. If you're able to deliver a measured response to the data and use that for historical purposes and keep it in history, but you're then taking decisions based on that, you have to start somewhere. But you have to use a combination of the sort of trends that have happened in the past, therefore they may happen in the future. But you also need to take a few risks every now and again and stick your necks out and not necessarily just say, well, because this happened in the past, therefore it's going to happen in the future. It's like doing a feasibility study on an island that's never had a hotel. If you did a feasibility study for that hotel, you'd say, well, there's no demand, therefore, don't bother building it. But you then have to use other factors that come into play. And overall, you build a position for the future that typically works. Otherwise, the three of us and our firms would not be in business for the length of time that we've been in business. People wouldn't trust us.
Well, you need to know where you've come from in order to know where you might go. You need to know the market. Yeah. You need to know where you've come from in order to figure out where you should be going. You need to know the position as it is today. So, and from that you can make estimates and you can venture to where you think things are going to go based on the underlying drivers. I'd love to paint a picture of what European and global hotel performance has looked like and where we think it's going. So I don't know if that's something you want to look onto.
I think it'll be interesting to hear.
Yeah? Shall I?
I think we should start with the presentation now, which we set the scene of each one of you, and then we continue on. So we start with yourself. Yeah.
So I thought it'd be useful just to set the scene and to look at what global hotel performance has been, firstly across the globe, and look specifically at Europe. And when you look at this picture, which is 2015 RevPAR growth, you think that it'd be fairly easy to identify, the markets that have performed well, so anything more than 5% growth, the markets that have performed less well, so positive at least, but not great growth, and then the markets which have, quite frankly, had a bit of a difficult time of late, where RevPAR's been going backwards. But I think, just as Russell said there and as we were talking about, is you can't simply look at the numbers. You need to understand the story behind it because things aren't always what they seem. So I'll start with North America. So there you see 6% growth. You'd think the market would be super happy. Everybody would be pleased about a pretty solid year. But the reality is they're not. And that's because growth has been going backward, and it's been going backward at a rapid rate. So it was 8% last year. In 14, 6% last year, and it's currently trending at about 2% growth. And so, quite frankly, quite literally, there has been blood on the streets in the listed hotel market, where share prices are down for US hotel REITs by between 30 to 50%. If you look at Europe, looks good, is good, and I'll talk to that in a bit more detail now. North Africa, you would think 8.5% growth, that's very good. Reality, not so good. That's because pretty much all North African markets went backwards last year, and the only one that didn't was Egypt. And the reason for that, and I know you're surprised by that because you're thinking, well, I saw the news, there's a big terrorist attack, Sharm el-Sheikh is empty, but the reality is 2015 was nowhere near as bad as 2014 when there was the second political uprising. And so it just goes to show that a terrorist attack is nowhere near as damaging to tourism as an unstable government that nobody trusts. Which just brings me back to North America, because it's quite interesting that the decline in performance there has been quite closely correlated to the rise in popularity of a certain Mr. Trump. Just saying. South Africa, quite simply, currency devaluation means it's buy one, get one free on your holidays at the moment there, so driving demand. Asia, far too big to look at as one place. And when you break it down into its components, Japan, currency devaluation, great year. And China, Chinese outbound market struggling a bit, and India, a good year of recovery. So just quickly onto Europe. I guess a very good year for most markets, but I'd probably best summarize this performance as the further away you were from Switzerland, the better off you were. Clearly nothing to do with the people, especially Andreas, and again, everything to do with currency strength, making it a more expensive destination. But if you look at that, you can see that the more established markets that recovered from the recession sooner, so the likes of the UK and Germany, Belgium, and even France, had a relatively good year with around the 5% growth, France being the exception because of what happened in the last couple of months. But as you move further south, along the Mediterranean, fantastic year, double-digit growth driven by displacement from North Africa. And further east, a great year, but recovering off some very lows, still recovering from lows. So looking forward to next year, or this year, to answer your question, Edmund, we still think it's going to be a very good year for most markets, despite Roger Boodle's taking a bit of the gloss off the optimism there. And that's really underpinned by a benign supply growth environment and continued demand growth through a weakened euro, and albeit slower economic growth, but still good economic growth, I think. So, Ed?
Thank you very much. Russell. By the way, I must say, this is going to my question of a good advisor. A good advisor is hinting the person that he forgot that the panel has got a presentation. So thank you very much, and you did it very gently.
Well, good morning, ladies and gentlemen, again, and thank you very much indeed for staying to listen. If this button works, we can move on to my slides, but for some reason, the word next springs to mind. Let's see if that works. Fantastic. So, as Robin's already indicated, 2015 was a record year for hotel performance in most parts of the world and across most of Europe. And as we'll shortly hear from Andreas, 2015 was also a record year for hotel transactions, 23.7 billion, according to our European Hotel Transactions Report published last week. Investors were attracted by continued RevPAR growth, along with the opportunity to achieve higher investment yields than other property types. So this has also had a positive effect in helping to drive growth in hotel values across most European hotel markets, as recorded again by our own Hotel Valuation Index report, also released last week. So as you can see, this growth in hotel values was pretty consistent across all the major sub-regions of Europe, and all regions are now converging on the overall average growth increase of 5%. You can see the volatility, however, in some of these regions as we move from the dizzy heights of 2006 through the turmoil of 2008 onwards to the comparative calm of today. And drilling down into the top and the bottom 5 cities, displaying the most and the least growth, we see that Madrid hotels were the star performers in terms of growth in values per room in euro terms. We have a big shout out for Madrid. Anybody here from Spain? Obviously not. It's too early for them, they haven't got up yet. So closely followed by Dublin, Birmingham, Athens, and Manchester, of course, well represented in the room, I'm sure. Now, Birmingham, Manchester were helped by the euro-sterling exchange rate. Geneva makes it into the bottom 5, despite a growth of almost 1% in hotel values in euro terms. However, here's the currency shift. In Swiss francs, there was a decline of 12% in hotel values. Values per room for hotels in Paris, perhaps not surprisingly, just fell by 0.5%, more than a token decline really, following the enormous difficulties felt by the French capital following the terrorist attacks in January and November. Hotels in Russia continue to feel the effects of political turmoil, international sanctions, currency devaluations, and falling oil prices. And if that wasn't enough, when you consider the values in local currency, St. Petersburg hotels declined by more than 25% year on year. And the city heads our list of the most volatile cities in Europe, which assesses the fluctuation in value and the overall risk associated with a hotel investment. Until recently, hotels in Istanbul were the darlings of investors, but hotel values there now reflect the economic challenges facing Turkey, along with terrorism attacks in the city and more widely across the country, along with political disputes with Russia hurting the overall economy. Finally, to conclude, hotels in Paris and London are still fighting it out for pole position in the league table, with Paris still having a slight edge over London in euro terms. Zurich, Geneva, Rome, and Amsterdam hotels are in the next tier. And finally, hotels in Milan, Munich, Barcelona, Edinburgh, and Copenhagen make up the cities which all lie above the overall average for Europe. So, putting my crystal ball on, if one can do that, Edward, as far as 2016 goes, despite an undercurrent of concern, we consider cautious optimism should do the trick. There's a prevalent feeling that the European hotel industry could reach the peak of the current investment cycle in the next year or so. So a somewhat different investment climate might be waiting for us this time next year in 2017 and beyond. By then, we'll at least know the results of the Brexit vote on June the 23rd. Thank you very much.
Thank you, Rafa. Very good. Andreas. And Andreas, thank you.
Good morning, everybody. Before we hand back to Edward for the continued interrogation of the three of us, I'll just wrap things up by giving you a brief overview of the transactional outlook for 2016. And I think cutting straight to the chase, one of the recurring questions that keeps on coming up and has been touched upon both yesterday and again today is, how close are we to the peak? Are we past the peak? How many years do we have left to go until we're at the peak? And I think certainly if you spend any material time in the US, you'd probably be thinking that we're certainly at the peak or potentially past it. And again, yesterday we heard the words post-peak environment being discussed as well. I'll give you a slightly different view, and I'll show you a data point in just a second that hopefully allows us to be slightly more optimistic of where we are in the cycle. So I don't think we're quite there yet. But before I do that, let me apologize to all of you in the audience who came and hoped for a run-through of what happened in 2015. We don't have the time for that, and there's a number of excellent publications out there for you to peruse at in your own time to make sure you haven't missed out on any of the major deals. But I think if I just cover a couple of talking points of what happened in 2015, and then we'll switch into the outlook for 2016 and beyond. I think in 2015, clearly there was something for everyone. So regardless of where you sat on the risk spectrum, there were opportunities for wealth preservation in capital cities that demanded a premium. And for the more opportunistic investor, there were a number of deals out there that had the associated risk attached to them. Overseas capital remained plentiful, and I'll touch on that in just a second again. And of course, we saw the reemergence of the mega deal or the mega merger, and it'll be very interesting to see how the integration of some of those deals will unfold in the coming months and years as brand portfolios are brought together. I think the final point on 2015 that I just want to highlight is towards the end of the year, we saw a lack of supply in the market in certain jurisdictions, which led to increased deal competition and priced certain players out of the market, most notably in the UK. So what's going to happen in 2016? We actually expect continued growth, either in volume or in value terms across most major markets, hopefully both in many markets. We expect overseas capital to continue to play a major role, both capital coming out of the US. They're probably driven more for reasons of cyclicality, where the domestic market, as we've heard numerous times now, is starting to look a bit shaky, and Europe may offer better opportunities, as well as Asian capital. And it's very risky to put Asian capital under one umbrella because the Asian investors, depending on where their funding is coming from, behave quite differently. But there's still opportunity there from a yield play and a diversification play standpoint, which makes Europe quite attractive. We expect to see further consolidation, both on a global and a regional scale, and it'll be interesting to see who the next buyer or victim is in that regard. And finally, we expect secondary churn out of the non-performing loan portfolios that have transacted in the last 2 or 3 years, and that will accelerate the single asset transactional market. We've already seen that happen in a big way in the UK, and that's continuing in areas like Ireland and Spain. But let me just go back to the point I made. Why do I believe we're not quite at the peak? And I'll show you a data point. It's Christie & Co. internal data. And what you see on the graph behind me is basically a 3-month rolling average of the gross deals agreed that Christie & Co. have done in the hospitality and the leisure sector over a prolonged period of time. So you've got my marketing people tell me that's an orchid-colored graph, or pink, as it were, from 1989 through 1996. And the blue line shows you the time period covering 2007 through 2016. Now, a couple of points to this data. It is slightly UK biased, but it's still reflective of overall trends that we see in Europe. It covers the full spectrum of portfolio deals down to independent smaller assets, so you don't have the kind of big deal volatility in there, as it were. And just to give you a rough scale of the amount of data it includes, we're currently selling about 500 hotels in Europe, so that gives you kind of a feeling for the scale of the data that we're talking about here. So, of course, it would be very interesting if we could see how this unfolds going forward. So, if the correlation continues from the 90s recession, and I'll leave it to each one of you to decide if you believe in the correlation, then we still have a number of years of continued improvement in terms of deal volume to go. Now, again, this is one data point in a very, very sophisticated market, and people have different views of if cycles repeat themselves or not. But hopefully there's an additional data point for the optimists in the room to say, okay, maybe we're not quite at the end yet. So on that note, I'll hand back over to Edward.
Thank you very much. Very interesting indeed. Thank you, which put it all in context. And Robin, can I ask you a question based on what you have said today? You're a benchmarking service, and you look at the markets as a whole, and compare it also to other markets as well, and other industries as well. There is a line of thought which is saying that the hotel market can follow what the residential market has done. In the end of the day, the hotels do provide residential services, and if you compare the cost of hotels to cost of residential, hotels are actually very, very cheap, both in terms of buying them and in particular in terms of staying them. If you compare staying in a hotel and staying at home, it is actually cheaper to stay in a hotel than to stay at home. Depends your home, of course.
Depends on which hotel you're staying at.
Or your home. But do you subscribe to this view?
Yeah.
Do you subscribe to this view?
So I don't quite understand the question in terms of what component of the residential market do you think
in terms of cost versus value.
And what is the trend in the residential market that you're referring to?
The residential market is way more progressive and way more expensive than the hotel market. Does this mean the hotels today are cheap? The hotel occupancy or the charges for the hotels in staying there are cheap compared to the residential or not? How do you see it in terms of you as a benchmarking service?
Well, that certainly is a left field question, and not one I've seen come across before. I think much like residential prices, hotel prices are driven by demand and supply. So you see very different trends in, say, London, for example, than you would see in the rest of the UK, and likewise other gateway cities versus rural places. So ultimately it's going to be demand and supply that drive the performance metrics of the hotel industry. And I think
you do not find any correlation between the two whatsoever?
I mean, I think they're both correlated to wider economic performance. I think if you look at it closely, certainly the hotel industry is, and whilst I haven't specifically looked at residential, my understanding it does closely correlate wider economic performance. So, I think they do follow each other to an extent, but they do have fundamentally different drivers in terms of what drives development and growth of supply, what product it gets put out there, and ultimately, what that means in terms of what opportunities or what there is for consumers to choose from. So probably not the answer you're looking for, but...
No, but it's a fair enough answer. Russell, do you have a view on this?
Well, it's an interesting correlation, and it's not one that we're regularly asked to do, but a lot of investors come to...
It does exist, though, as a comparable in markets.
It does, and the reason that as I'll explain, a lot of investors are looking at different classes of real estate in which to put their capital and to spread in a diversified, balanced risk way. And very often the same sort of investors that we meet who are interested in acquiring hotels are looking at residential development as an alternative or a complementary form of investment. I don't know that one tracks the other so much. What I am finding, however, is that hotels are increasingly being viewed as a real estate asset class in their own right, in the way that perhaps previously in years gone by, there was industrial, there was commercial, there was residential, there was retail. Now hotels are viewed on the same platform. And I think that is only to the good of the hotel business, and it means that a lot more people understand the dynamics of hotel investment. But the real difference between residential and hotel investment is, are you looking for an active or a passive investment? When a residential play is involved, you're essentially saying, I'm going to leave my money in this residential development, whether it's an individual house purchase or whatever, for a number of years. And I'm not really able to dictate the pace of how that investment fares. And at some point in the future, I'll check out of that, and hopefully I will have made a capital gain and move on to the next one. As far as hotel investment is concerned, depending on how you're stepping in, whether it's on the basis of owning a building and employing a manager and or a franchisee or something like that, and taking the volatile investment return based on annual performance, or if it's a lease based on some sort of formula, you're judging the performance of the hotel based on how that hotel behaves in the market and responds to the supply and demand pressures that Robin was talking about.
I think just to add to that, I mean, as a company, we don't deal with residential by choice, because we like the complexity of the operational business adding value to the real estate. And I think that's one of the key differentiators that Russell's just touched on is, as an investor, either you have the appetite to, especially if you're talking about a owner-operated model, to say, okay, I need to understand the actual business that adds value to the real estate. Typically, the individual living inside of a residential home, unless they're a celebrity, don't add value to the residential real estate. So I think I understand the question, but I think there's a difference in terms of the complexity of what adds value to the real estate that needs to be taken into consideration as well.
Because there is a very big disparity between the two at the moment, and not necessarily a justified gap between the residential and hotel market.
That determines how you assess the risk of the two against each other. So I think, the hotel sector has always lagged behind residential, office, and I guess more blue chip asset classes, but I think that gap has narrowed over time and probably will continue to narrow.
But the good news is that there has never been such an unprecedented demand for acquiring hotel real estate.
Is this because of this reason, or because of
it's
the cash flow generation?
Firstly, it's because the investment quality is there, the potential returns are there, and secondly, that hotels have come out of their shell, and hotels provide across the board an opportunity for those who are just general real estate investors to get into an exciting part of the real estate sector.
I think this is also driven because of people a bit more familiarized, better advised, and understanding the risk and the reward which is involved in purchasing hotel. And I think as we are running out of time, I just want to have a last question to all three of you. What is the next big thing, either in hotel ownership and in the hotel operations, in your opinion? And if I can start with you, Andreas, please.
Well, I think the industry is obviously going through a bit of a change with disruptors coming in, and I hate to mention the word again, but Airbnb coming into play and so on. So I think that will impact some of the market going forward. I think also you've had a huge influx of overseas capital, especially the Asian capital, has come into the European market, which is driving different decisions for that. So certain investors are coming into the market to build platforms in Europe and roll out, but a lot of the investment has actually been to repatriate brands from Europe back into Asia. If you look at, for example, the Club Med deal and so on. So I think you'll see some interesting developments there in terms of the evolution, not just of passive investors, but people actually trying to leverage what they've purchased and use it on a global scale.
Mm-hmm. Okay, Robin?
Yeah, so I mean, I'd say the next big thing is really one of the things that have been happening already, which is the professionalization of the industry, both from a consumer perspective and the way that they buy hotels, and from a hotelier perspective in terms of branding and distribution. So I think the thing that's changed the most, and the thing that is going to continue to change the most, is distribution.
Mm-hmm. Before I move to Russell, would this, in your opinion, we create a more static or more active market?
More active, definitely.
That's good. Russell?
Gosh, where do you start here? There are some artificial issues that are coming up, and I regard the June 23rd Brexit vote as one of the artificial things. And I think that we're going to find that until then, as Roger Bootle was inferring, there's going to be a lot of indecision, and that people will breathe a sigh of relief on the 24th, whichever way the vote goes, by the way, that at least that level of uncertainty has now been removed. What I think we will find in the period between then is that there will be quite a rush to do deals because of the people's concerns as to what might be happening. And then afterwards, there will be a rush of deals because people will say, well, what was all the fuss about? So I'm rather hopeful. 2016 will continue to see the sort of levels of activity that we've got used to. Perhaps not as bright as was the case in 2015, but as we sit here in 12 months' time, I think we'll be asking ourselves, well, what was all the fuss all about?
Good. I think, ladies and gentlemen, we've got literally 2 minutes for questions. So if there is any questions from the audience, we're very happy to receive them. And if not, so really, Robin, Andreas, Russell, thank you very much.
Pleasure.
Right.